Today, we got a very special show for you. We are talking about the BiggerPockets rated top 10 rookie investor markets, where you may be surprised to hear Jacksonville won. Anyways, that's not all we're going to talk about. We're going to talk about who's on this list, what the qualities are of cities, what the criteria is like, and then we're going to go a little bit behind kind of like the thinking of what actually makes a really good rookie market, according to Gregg's experience of having helped thousands of investors get into this asset class. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, here in studio, inside JWB World Headquarters, the man that I affectionately like GC because he's got the genius concepts, knows how to read cash flows, is a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
GC, before I read off the top 10 markets according to BiggerPockets, we got breaking news. We haven't had breaking news in a while, GC.
I know.
What's the breaking news? I heard that JWB got recognized as a best places to work in Inc. magazine. Tell me about that.
You know it. This is the award that matters the most to us.
Yeah.
We've been blessed to win, I don't know, more times than I have fingers. We were recognized just recently at Inc. magazine 2026 best workplaces in all of America. There were
in all of America.
In all of America.
Oh, wow.
Only 577 companies that were recognized as the best workplace to work. We were one of them.
That's nice.
There were 5 in Jacksonville. We were one of them, of course. And a real statement and just a culmination of all of what we believe. We believe that our team, the reason that you all choose to invest with us, we want to pour our heart and our soul and our invest into our team. And we love that the team feels like this is the best place to work because it helps us attract more and better talent. So very happy to share that with all of you. It's a big win. It's a community win, and something that we're really proud of.
First question, just make sure you got 10 fingers?
I have 10. Okay. And it's more than 10.
Okay. All right. Got it. I don't know if you had fingers on your left hand or something like that. Second question. I've read this before. I feel like it's always been best places to work in Jacksonville. Have you guys won the best places to work in America award before?
We have won that. I'm going to guess maybe 3 times. Oh. So this is a big deal to win it. And there's a number of different best workplaces award with the local. There's the state, which we've also won, and we've also won the national with Inc. A few times here. So
perfect.
Yeah,
very nice.
30 pumped.
And I feel every time we talk about one of the awards, remember the first time that we started talking about these awards, I was like, why do awards even matter, GC, right? Like, it's all just kind of like PR and whatnot. But you guys really, really care about this one. You really care about this, like, best workplaces, and it's because of a business outcome.
Yes, absolutely. I mean, we believe that the best business outcomes for us come when our clients are served the best. And when we have the best talent and we get to attract the best talent, it leads to better business outcomes for us. It's interesting. I used to run our IT department, and one year we didn't win. And I went to our IT department and we ran some surveys internally. And we said, hey, how come we didn't win this year? What are the biggest frustrations? And one of the frustrations at that time was our IT. And I went to our IT department. I said, let me in the bigger picture. We need to win best places to work because these business outcomes, it creates a better environment. It helps us attract talent. And I help them so that we're not just solving tickets, IT ticket here, we're creating the best work we possibly can. And we have a wonderful IT team, share with them the big picture. And what do you know? Survey results for our IT within 1 year got dramatically better. And we won best place to work the next year. So we kind of managed to this, if we don't win every year. There have been a few years that we haven't won. If we don't win, we really understand why we didn't win. And we use that to improve the experience for all of our teammates.
And so I always tee you up to talk about the business outcome of, like, this award in particular helps you attract talent. Yeah. Right. Like, people, when they're looking for a job, like, not everybody, right? Most folks coming out of college or when they're looking to make a transition, everybody has the luxury of saying, like, I work in my passion, or my passion is this or that. A lot of people look for what are the best places to work, like the most talented folks that feel like they got a bad situation in their last situation and want to come and prove themselves, look for places to work and apply there, which to me explains why you all have, such incredible talent in a local real estate business here. It isn't a Fortune 500 company or whatever.
Yes. I wish somebody had told me when I was coming out of college to go to best places to work list and apply there.
Yeah.
You know, that's what I will tell my kids to do, because I did the opposite. I went to corporate America and I thought that was the right path and it didn't work out for me. But man, you know, if you can work in a place where you're surrounded by positive people, you're a part of something bigger than yourself, man, you are a lucky individual coming to work every single day. What we have here.
Nice. Congrats, man. Really cool. Really national thing is cool.
Yeah,
And
thanks,
we hadn't done breaking news in a while, which means we got another one, GC.
Yeah.
Breaking news. JWB has paid out more than $5 million in cash flow the month of May. Tell me more.
That's right, buddy. 1,740 clients received $5,281,206 in positive cash flow just from their rental property investments. This doesn't even include the other investment options that we have. To cross that $5 million threshold a month, really a wonderful accomplishment for the team. That's a lot of quiche going out to a lot of people. And so we're really proud to be a part of everybody's retirements and the financial outcomes that are important to you. We get to be a big part of that. And so we're very excited about it.
When we talk about this number and it continues to go up, like for me, it's like you guys are, you know, it's hard. What is it? Something like 70-something% of like business owners don't make it past like 5 years. A much smaller percent, 1% do a $1 million business, like 1% of that do a $10 million business, right? Like all these different kinds of numbers. This isn't even just having a $5 million per month business.
No.
This is that you guys have collected way more than $5 million worth of rent, you know, done all that you need to do with that stuff, and then redistribute that as cash in the pocket for rental property investors. So the scale of operations to distribute $5.281 million, 1,000 plus investors, to me by itself is like a super incredible operation that you guys are doing of distributing that kind of money, man.
I mean,
Santa Claus.
You know, our accounting team doesn't get the love that they deserve. Can you imagine just receiving $5 million? It's like a lot more than that. I call it $7 million of rental income each month from 6,000 rental properties, and making sure every dollar and cent is accounted for and then distributed that on the day, every single month. I mean, it's an incredible job. So yeah, there's a lot that goes into it, and we're just here for it.
I imagine collecting $7 million a month in cash flow all the time. I never think about giving back $5 just for the job.
We got to give it back, which is good, which we love,
I got it. All right, let's get to the main event here. We wanted to talk about this. I'm looking for my share things here. Obviously, I'm a rookie. This top 10 markets for rookie investors shared by BiggerPockets. I'm just going to read them out real quick, GC, and then we're going to dive into what makes this stuff interesting, right? So number one, actually 10-1, right? Let's make it. Louisville, Kentucky, where the median home price of $261,000 is number 10. Baltimore, Maryland, median home price $188,000. Number 9. Raleigh, North Carolina, median home price $433,000, almost $434,000. Number 8. Detroit, Michigan is making a lot of noise these days, but only number 7 here, with a median home price of a tiny $75 here. St. Louis, Missouri, with a median home price of $181,000. I'm wondering where Jeff Pettyjohn is right now.
I know.
Houston, Texas, with a median home price of $264,000 at 5. At ATL, Georgia, median home price of $385,000.
Where's Eddie?
Where's Eddie Harris? What's famous? What are famous folks? These cities. Hot Atlanta. San Antonio, Texas, median price of $249,000, coming in strong at number 3. Birmingham, Alabama, which we've spoken about before, median home price of $135,000. And then numero uno, number 1, Greg, that's number 1 in Spanish. Jacksonville, Florida, median home price of $282,000. So that's the top 10 list.
Yes.
Let's talk about, first of all, were you surprised?
No. Not that you were number 1.
Did any of these cities surprise you? You're not surprised that Jacksonville's number 1. You've been investing millions of dollars into Jacksonville for a long time. Did any of these cities surprise you?
Raleigh surprised me. Atlanta surprised me. The higher price markets surprised me a little bit.
Yeah, higher price markets surprised. I hadn't heard of a market in North Carolina, like before. I had, Atlanta surprised less, because I feel like the times I've been to Atlanta in the past, having come from Miami, like I know friends that moved to Atlanta to like lower their cost of living in a more complete city. That's something that I hear a lot in Jacksonville, and those kinds of things. But Raleigh definitely surprised me. But after being to Raleigh, I'm not super surprised of like why it's like such a good market as well.
Yeah, I heard a lot about Raleigh
Yeah.
and Charlotte probably 5, 10 years ago as far as a good market to invest in. The same thing for Atlanta. But those markets have shot up. And so no, but these are a lot of the markets that we have investors deciding between when they're thinking about investing in rental properties. So yeah, this list seems about right.
Sounds good, buddy. Well, let's these lists, any other listicle, right, that people do is arbitrary. You ask one investor one, they might do 10 different ones or in different orders or whatnot.
Right.
I think it's important to think about kind of like the thing behind it, right? So this article talked about what makes a good rookie market. They had 4 market tests. One is, can I afford to get in? 2 is there strong rental demand? 3 is the economy diversified? 4 is, can you survive mistakes as a rookie investor? What do you think about those 4 as an overall criteria?
I like it. I like it a lot.
Yeah. Do you think can I afford to get in, number 1? Is that
no, for me, I am very risk mitigated in all things that I do. And so for me, and if I was putting myself back in the lens of a rookie investor, survival would have been number 1. I'm also adding the fact that I understand how you really win in this game. You win in this game by being here long term and by stacking assets and growing this army of income producing assets. So I know that survival is the most important thing on your first investment, and then the ability to grow in that market over time is really how you win. So out of those 4, I think survival is the first and most important, because if you don't survive your first investment, there's no way you're going to get to number 2. If you strike out first at bat or bad experience, you're going to give up. You're not going to come back. And so I would go with survival as the most important thing.
I agree with the survival thing after all the stories that I hear on the show, even Leslie's story last week, right? Like it's two-sided. One is I'm always pleasantly surprised with how many investors come on the show and they didn't survive their first investment or a bad experience their first investment, and are still kind of like steadfast. I want to get into real estate. They persevere. They find JWB, and now the lights turn on, right? And then there's so I think people can survive one bad investment. Imagine that for 10 that did it, and we're like, real estate's not for me. 1,000 or 1,000, right? So to me, that's a big haymaker to take. For those that survive it, what is very clear to me is that our investors that are in our community have been doing this a long time. They survived their first investment. That first investment has been around for a while. Is the whole like equity play, the financial engineering, they start to be able to like take advantage of as time goes on. You hear it all the time. It's time, and it's like how much time in real estate you're in. Things get better. So the idea that I want my first one to go well. Well, I think the way that when I first started investing with JWB, I remember Stet described it to me as like, you just want to get on base, man. Like you want to get base and you want the market to start doing its thing for you as soon as you can. And then you just kind of like figure things out around it. So like, to me, like the survivability piece is one part. Does it not knock me out of like ever want a real estate investor? But also just want to, I want the first one to work. I don't want to like sell it because I want to like stay in this asset class, be able to benefit from like all the things that happen over time.
I think you nailed it. That's the most important thing.
So that being said, key to survivability.
The right team. The right team is the most important thing. It's way more than the other stats and the comparisons we're going to make here. If you don't have a team that is worthy of managing your money, you should consider market or that investment or really rental property investing long term. It is all about the team. That is the first most important thing, because the team is what turns those fancy formas into money into your bank account. And the team is what controls the experience for you to make sure that this is something you're going to be excited about for 5 years, for 10 years, for 15 years, 20 years, so that it can produce these wonderful outcomes.
When you say the right team, I get it, right? We talk about this all the time. It's the right order of operations is, like most people think of like, oh, I need to go find a property, and then I'm like, or maybe like I'm in love with a market and I find a property in that market. Very few people think, well, first I want to find a team I really, really trust to give my money to. And you'll find that, and then you analyze what markets are in, and then the property thing becomes easy, like makes sense for all the survivability. I would be more specific about survivability. Team is the reason why. I think what survives, the reason survive is experience, and the experience is provided by the team, right? Like, and experience can be a bunch of different things, right? Like, experience can be losing my shirt on this thing month over month, or it can just be like, man, I just don't really like dealing with, all the different things I need to deal with. It's take it right. Cause you can be a yourself investor, show up, you're making money hand over fist month over month, but it's ruining your freaking life with all the things you need to do.
Yep.
Right. So like, I think more broader, it's the experience of it. Like, how much stress does it provide in your day-to-day life? How many KTAs is what I call it? How many kitchen table arguments are happening because of this like property that you invest in with your significant other? Like, how smooth is this thing overall is absolutely what I say like survivability is all about.
Oh, I think you're 100% right. And that's the reason why most people know that you can make great money in rental property investing. That's not really debated. If you buy and you hold, most people know that you're going to end up winning. But even though we generally all know that, vast majority of Americans do not invest in rental properties. And the reason is because of the experience. Because it has been so bad for so long for so many people that they knowingly give up an asset class that could really change their financial future because they're so scared about the experience. So that you have to do your due diligence and make sure that before you put your money into rental property investing, that team can control and create this one experience for you. It's harder to find than just Googling a property manager or finding a realtor or reading the list of best places to invest as a rookie. You've got to do the due diligence, and part of that's you guys being here today.
Yeah, love it, love it. So let's dive a little bit more into the kind of like the criteria, and then I want to just talk about kind of like a couple of these markets and like break down the similarities between them and why they're good. But so we said survivability is number one. Then there's affordability, strong rental demand, diversified economy. Which one would you rank second on your list there?
Well, are we talking about overall importance, or are we
For
talking
rookies?
for rookies? I just feel like there's kind of like a linear approach to it. I think affordability is probably where you start first. Because if the market is too expensive and you can't afford to get into it, doesn't matter how great the economy and the rental demand is, you're just not going to be a player in that market. So it does need to be affordable, not just for the amount of dollars that you have, but affordability is important because at the end of the day, we need to be buying assets that pay for themselves every single month. And so it's not just, do I have enough dollars to buy a house in this market? It is, do the numbers pencil so that this app can produce monthly income every single month for you? So, so affordability, number one. If we don't have enough budget to buy something in the market, we can't get in. But even more important than that, make sure that there's positive cash flow from day one. And that's really why I would start with affordability.
Yeah, the term, what is it? Price to rent ratio. Is that the term, right? Like this like balance between how expensive the home is and how much you get for rent. To me, like, I would rank that as the number one thing of like my measure of affordability before actual total price.
Yes.
And then total price it comes in as well, right? Because you also need, like, if I think of, my past life when I wanted to be a real estate investor and I couldn't. I'm living in Miami. Everything's really, really expensive. But also, I also wasn't going to get positive cash flow. So like the equation is like, man, can I shell out at that time $400,000 to get something? It was like $100 or $200 a month in rent in,
Right.
And it doesn't feel appealing. But what you've talked about for us is this idea of like, not only is it appealing but it's not very scalable.
Right.
Right. Like the idea that like once you start piling up rental properties, if you're going more and more cash flow negative every single month, it starts to be less appetizing. But for a rookie making the first investment, it's just the idea of like, am I going negative in my cash flow, and like how much cash am I putting out? Then makes me feel like safe or unsafe with like how much I'm doing it in relation to my net worth.
Yep. Exactly. We talk about flywheels on this show. And when you buy in the right market that is affordable and has a good rent to price ratio, you're creating a positive flywheel here where you're creating positive cash flow. and the amount that you are required to buy your next home is less than another market that's way more expensive. And so it starts to build on itself, and you're creating this positive flywheel. You're thinking positively about it. Your bank account is reflecting positivity and helps you, this will turn. The opposite is true. Yeah. If you buy in a market that is unaffordable, you're creating a negative flywheel. Yeah. You put a lot more money out, maybe twice as much money out, and then that money is producing a liability for you. It is costing you money every single month. And so you're just not like really fired up about putting twice as much money out the next time to go another $200, $300, $400 a month negative. That's negative. Yeah. Flywheel.
The experience is less.
The experience is less. It all boils down to experience.
It comes back down to experience.
But no matter how nice the people are and how much they are on their stuff, if you're negatively cash flowing and you're creating this negative flywheel, you're not going to come back and buy 3, 5, 10 properties and hold on for 10 years. And that's really what you need to do in order to achieve that financial outcome.
I mean, I think it's just a straight line. Negative cash flow lends itself to being a negative experience.
Yeah. It is a very big determinant. Agreed.
In a big way. All right. So that's affordability. To no surprise, there's only one market here that's at like $400,000 in median price. Only in another market that's in the 300,000s, right? That's Raleigh and Atlanta.
Yeah. Just a caveat here. I don't know exactly where BiggerPockets or Zillow gets their home prices.
Median price.
Yeah, their median price. It seems way low to me across the board for all of the markets. So, for example, Jacksonville's median home price is about $360,000, and they list us as $283. Yeah. I know Atlanta is way more than whatever 350 or 60 that it says. Raleigh's is higher than 453. So I would sell all of these up significantly. I know Detroit's is higher than 5. Yeah. So I would scale all of these price points significantly. You're probably going to end in the same spot, which is Jacksonville affordable, and most of these on this list are affordable. But just so you know, real dollars, it's more expensive.
Yeah, that's a really good call. I just want to read this thing that Lee sent in private in the chat. He says, Pablo, your eyes actually sparkle when you are trying to read the screen. Thanks, buddy.
Only when your eyes read the screen. I see your eyes sparkling all the time, Bob.
I appreciate it. All right, cool. Thanks, Lee. I appreciate that, bud. I think he's trying to make me, but I'd take that as a compliment, just for the record. Just that's what I'm used to from Lee. All right, so is affordability becomes the linear thing, then is strong rental demand kind of like the next one?
Yeah, that's where I would go next.
Yeah.
Because in order for this to work, now I'm moving beyond day one. Yeah. The affordability is like, how do I set this thing up right from day one? The affordability is important, but quickly it goes to maintaining and growing this experience, maintaining and growing this positive cash flow along with the stuff that the team needs to control for you. And so a big part of maintaining and growing and having a long runway for positive cash flow comes down to rental demand. And that's where I would go next. It's, how big is your renter population? How big is your population growth so that it is feeding more both positive renter growth as well as home base growth? And that's where you really start to think about the jobs and the economy that comes into support. And so rental demand is where I would go next.
Yeah, I think about rental demand. As we're going through this, it keeps coming back with experience, right? Like it's still kind of like experience is like the number one domino, right? So it's like if there's low rental demand, then I'm just always going to be afraid that my renter's going to leave.
100%.
And that's going to lead to staying up at night. And like the moment that somebody leaves, because inevitably renters move out, you have a super long term and you're thinking, should I just sell this thing or whatever, right? So it's like, as a rookie investor, it's like, how do I sleep best at night? Want that strong rent demand, right? Like you want to have a growing population that is going to continue to feed this thing. You're going to want like a good mix of housing, and there's going to be like a certain amount of like people moving there. Then there's going to be a certain amount of like jobs that are being made for the type of renter that you want to have, right? And those kinds of things. Me feels like a really, really good test to ask yourself.
Yes. As a rookie, you need your first at bat to be a single, double, if we can get a triple run, that's great, but it needs to be on base, right?
Triply on.
Well, the way that you are going to feel like you're on base is when your house is occupied.
Yeah.
And
it's a little money.
And it's making at least a little bit of money.
Yeah.
And then the way you're going to feel really good about this being a double or a triple or a home run is seeing that there's a runway for positive rental growth along the way.
Yeah.
Because majority of your expenses are flat. So as you get rent growth along the way, that $100 a month in cash flow one turns into $300 a month in a few years, or $500 a month. So yeah, if we want to get on base and we're thinking about this from the rookie lens, strong rental demand leads to high occupancy, and over the long haul, you're going to see significantly more rental price growth, which is really important.
Got it. And then the last one is diversified economy. This feels like something a rookie themselves.
Yeah, not enough to do.
Yeah. What's important about that?
We got to understand the economic job-based substantiating the rental demand and the rent growth. We have to understand types of jobs and how many jobs, and are the jobs growing, and really what are the financial anchors that are substantiating your marketplace. And it needs to be more than one. Some of these out there that are a main stop for one employer, and if that one employer, the CEO, wakes up on the wrong side of the bed or does something. We've seen CEOs that are just out and about, and all of a sudden business is very different because they made a boneheaded decision. Well, all of a sudden you're at risk. You have one financial, economic employer that is really driving the economy there. So we've got to understand our job base. You have to have multiple, very strong and long tenured and companies. The best way to look at that is your Fortune 500 companies. And it's really easy to find. The economic data is all free to find. It's very easy and accessible. Just a lot of people just don't know where to go. An easy way to look at is how many Fortune 500 companies have headquarters in your area. And that's an easy way to tell. If none is the answer, might not be the right place, right? If it's only one, probably need to do a little more due diligence. When you start to get to 2, 3, 4, 500 Fortune 500 companies, that's when you really feel like you have a diverse economy.
I wonder I think Fortune 500 companies is good. I would say I would be more interested in how concentrated is your local economy in one industry, right? Like what I experienced in Miami before Miami became like a more full city was that when tourism went and when construction went, Miami went, and that was like really big ups and downs. They had a handful of Fortune 500 companies, but like if it's too concentrated in one sector, then if that sector struggles, then you're in trouble, right? Like look at tech heavy places that don't have other economies. It's a volatile part of the economy, right? So like when the tech sector goes, it goes, right? So it's like, I think Fortune 500 companies add a level of stability, but to the point of, how much does the town get disrupted if like some industry gets hit? Probably a pretty good measure of it, right?
I think you're spot on. I think look at this as kind of like a what is easy information to kind of understand and comprehend. Rookie investor, look up the number of Fortune 500 companies in there, right? It's easy to understand. What you're talking about is probably more important. It's just harder to understand and define and get that information, right? It's not very readily available as far as like how much of your economy dependent on the tech sector or transportation, logistics, or military or government. Got to dig a little bit deep. So I totally agree with you that it is probably more important to understand the composition of the industries to make sure you're not too dependent on one industry. But it's just a little bit harder. So that's where I think we start with Fortune 500 companies, and then you continue to dig a little bit deeper.
Yeah, that makes sense. Okay. And Bretta has a question here. He says, much of what I'm seeing with 30% down has zero to negative cash flow. How is that still a good deal / investment?
Great question, MJ. So, if you are looking at rental property investments now, with interest rates being what they're higher than we all want them to be, and you are looking at the pro forma and you're looking at the cash flow, you're going to come to a conclusion that they're cash flow negative. So you're right on board there. Now, why am I saying that it's still a good time to buy rental properties? The reason is because builders recognize this, especially those who sell to investors, and they're doing something about it. And what they are doing is a combination of incentives that allows you to produce positive cash flow. And they do that by either buying down your interest rate significantly and sometimes giving you huge lump sum cash incentive payouts that come to you. So whereas in the past, 5 years ago, there was I had never seen a JWB property that you were able to buy the property and also receive a cash payout. That has been the norm now for a couple of years, where investors are able to buy the asset and basically get all of the positive cash flow they would have received over, let's say, 3 years in a $5,000 or $10,000 lump sum cash payout at closing. So it really is, I think you're 100% spot on. I love the question. If you're only looking at the pro formas out there, and I'm speaking beyond JWB because we do a pretty good job of sharing how the incentives work and the kilo works with ours. But aside, if you're trying to run numbers and you're not getting incentives, you're probably not going to see positive cash just because your interest rates are too high. And because even at 25% or 30% down, the rents are probably not going to be enough to positive cash flow. That's why you need incentives right now. That's why a lot of builders are giving incentives. And the cool thing for you as an investor is think about what happens in 1 year, 2 years, when interest rates come down. What's going to happen is it's going to be creating a great refinance opportunity for you. Because when interest rates come back down, let's say in a year, be able to refinance and get a much lower interest rate than you have today. But you would have pocketed that $5,000, maybe $10,000, maybe more of incentive dollars, one. And you would wind up in a similar spot later down the road where you have a low interest rate, your asset is producing positive cash flow, but you really won on that aid. So that was a long explanation, but at the end of the day, incentives are the reason that it make it a great investment today, as far as a cash flow producing investment, whereas you just didn't have those in the past. And that's the result of high interest rates.
See, as you explained that, I think this is something I've noticed, that I don't think we've talked about a lot, right? But like for where the state of the economy is right now and finding positive, and we say it, and this idea of incentives, front loading cash flow for an investor, there seems to be a need in order to for this to work for you. It's two things. One, it's understanding those dynamics, understanding that cash flow can mean things like you can look at cash flow in a month-to-month version. You can look at it as a year-over-year cash flow. You can look at it as a year cash flow, or 10-year cash flow. However you want to do it, right? Cash flow is just a word, and your length of time on cash flow will vary, whether it's positive or negative, depending on current market conditions. And then the other side of that piece is the trust in the operator to be able to deliver those numbers, right? Like if I don't trust my operator to operate at a certain standard, I'm going to get, let's say, $10,000 in cash up front.
Right.
And I'm being told, cool, these $10,000 in cash, if you break it up, that'll make you have positive cash flow over the next 3 years. And in year 3, then you're not going to need that, and you're going to be in positive cash flow, and all these other things have also happened, and blah, blah, blah. Then I can really, really believe that. If you don't believe that from an operator, then you're just saying, I don't know. You're just kind of like giving me G's, and I don't really think this is going to happen. What if I have somewhere I go negative $10,000 in year 1? Right. So I think that's the psychology that's very, very real to someone like an MJ that's considering this thing. Okay, well, if I trust operator, then I can afford to get cash flow in a bigger timeline horizon. And if I look at it in a bigger timeline horizon, these incentives are happening, then I have the opportunity to take advantage of a market where everybody's afraid, and I can go take advantage of it.
Yeah, I think that's really important. I think it all starts with trust. And if we don't have the trust, there's not much of an opportunity for that client to feel really good about any of the decisions, probably with the initial buying decision. So I think it all starts with trust. I think parts is just the reality, guys, is that we talk about positive cash flow and we set up our investments. And I would assume most operators are set up their investments to be positive cash flow from day one. Ours are. But the reality is you gotta have some type of a stomach for the expected when you're in properties. And it will be a year where it goes cash flow negative. That's just the reality. It's my rental properties. I own 100 of them.
Yeah.
Pablo, it's been that way for you. So, we set this up to make sure. And when you invest, you set this up in your mind to make sure that this is positive cash flow from day one. But we also have to recognize that if we go cash flow negative because some unforeseen expense in year 2 or year 6 or whatnot, it's still a win.
Yeah.
I think we also need to kind of, in order for this to be something that's really a good investment for you, rental properties for you guys long term, like having the stomach to know there are going to be some wins where we have way more positive cash flow than your pro forma expected. And then there's going to be a year where you probably go cash flow negative. That's just real life. And we can still accomplish these large financial outcomes given both of those situations. So I think there's part of that too.
Yeah. It's like a little mini business, right? So it's like, in business, you look at, sometimes you're a business that's, you look at the numbers and you're like, oh man, like year 2, I'm going to turn this thing around. And then the next 10 years are really gravy. Or you're going to be like, oh, I'm going to buy this right now. I know in year 5, this has happened, whatever, right? Like it's kind of like that. It's almost like a business operator.
100%.
Yeah, cool. Keep going here, GC. So when I look at these markets, right? So that was the test, right? Can you afford it? Is there strong brand? Is the economy diversified? Can you survive mistakes, right? So that's the prism that we're looking at it. I want to start grouping these in kind of like what these cities, I think there's generalities that we make. I think that there is appreciation markets in the city, which means it's high priced and you're betting on appreciation. The cash flow is going to be lower, be even negative.
Right.
To start, it could be like the super low priced one. And then there's going to be kind of like those like middle ones that fit in. Let's start with the appreciation first markets. Raleigh and Atlanta are clearly appreciation first markets. They're both over 300, according to this, probably higher than that, right? But like, Atlanta has a 308,000 median home price. Raleigh has in the 433,000 median home price. Both really well-established markets, right? Like I was just in Raleigh. The Research Triangle is there. IBM is there, right? Like all these kind of like good things are happening. It's expensive, but it's also like really well-established. Atlanta kind of the same. Coca-Cola, like a bunch of well-established things. Higher priced. What is, characteristics of those two markets? What do you think of that?
Just diverse, strong economies,
Yeah.
huge population growth.
Yeah.
Their downtowns have really blossomed over the last, I don't know when down Atlanta blossomed forever ago.
Yeah.
And, in Raleigh,
multiple urban centers. Like Atlanta has downtown Atlanta, it has Midtown, it has like multiple urban centers. Raleigh has like multiple markets. Raleigh, Durham, right? Like it's like multiple cities there.
And I just think like if you think about like the life cycle, the growth cycle of a city, like Atlanta has become a full, mature market in a sense, right? Like they got 5 million people living there. Their home prices are well above the national median. And the same could be said for Raleigh. Raleigh's a little bit newer to the game. But still, a ton of economic growth and home prices are high. So when you get to this point in this life cycle of high prices being so high, you miss out on the opportunity to produce positive cash flow from day one. You give up this affordability.
Yep.
And the reality is some of these markets that are in the middle, which we'll talk about next, some of these markets will be like Atlanta and will be like Raleigh in 10 years. Some will not. Some will stay, and then some will actually go down. But if you could find somebody or some market that is in the middle there that you believe has the same tendencies and track record and then positive wheel momentum that it can elevate it type of ascending, well, you're going to win a ton because your home price appreciation will go up dramatically.
Yeah.
And I don't know if Raleigh or Atlanta is going to pop more. I could probably sit here and say that the prospects of population growth in a city, Raleigh or Atlanta, are really, really strong, which does drive future home price appreciation. And big companies are already there. They already believe in the thesis of Atlanta. And so they're likely to come there. So I don't know which is the better long-term prospects. I think anybody from Atlanta or Raleigh or Jacksonville would probably make the pitch that theirs is going to be better. But what I know is it takes a lot more dollars to get in there.
True.
And so the dollars and the return on investment on dollars is probably going to be less in those markets that have a lot of that are higher priced today than some of these other markets that are lower priced.
Got it. I know you said that we're going to go into like that middle tier next, but I have creative direction here on the show. And I would like to go into the cash flow heavy ones because I think there's like the bigger contrast there. So the cash flow heavy markets are these like less expensive markets. Birmingham at 135,000, St. Louis at 181, Detroit at 75,000. What are the other ones here? Louisville, which was kind of a surprise here, and Baltimore, right? Baltimore, Louisville both surprised me that are on this list. 188, and then Louisville at like 261. These lower priced cash flow plays, all idea of it's like, the price is lower, have the promise of more monthly cash flow maybe on day one, but they don't have this kind of like the rest of the stuff that you were talking about. They don't have as many, like as a diversified economy. They don't have these like big things going for them. What do you think about this group?
Rookie investors look first as their go-to because everybody loves a low price tag. But for some rookie investors, that is the only investment they make because they stumble into a situation that is not a great experience.
Yeah.
And, the unfortunate thing is that they stub their toe and they never come back and they never, take advantage of this asset class going forward. So I worry about the low price tag for investors because it is so attractive, but we have to look beyond a low price tag, right? Your job as a financial engineer and my job and Pablo's job is not the least amount of money. Our job is to produce a great financial outcome, and we do that by producing a great return on investment. If you spent 70 grand and you made 1% on your money, would you be happier than if you spent 150 grand, but you made 11% on your money? Probably not. You'd be way happier at 150 grand and making 11%. So, I just think so many people get so excited about the price tag way too much. Now, if you can get into a great operator with great experience that has all of these other things that are maybe even more important than cash flow, definitely more important than a low price tag, well, that's how you really, really win. And then maybe you invest in one of these other markets, but don't just get excited at the low price tag. There's just many stories and horror stories in our group, in the chat. I'm sure you guys are firing off right now, because we've heard it many, many times on the show.
Yeah, I'm glad you brought up the word experience again, because we kind of came off of that on like on the high appreciation markets, right? I would say if you look at it from the experience lens, you're purchasing something, like a very high price comes with a certain level of, right? Like there's like a certain level of like, oh, okay, well, I paid a lot for this, so I feel safe. But the moment that something that you paid a lot for doesn't feel 100% safe, you're going to freak out because you're like, I paid so much for this.
True.
On the other side, you pay very little for things. You're like, all right, I got some money to play with here, but you pay for what you get for, right?
Yeah.
So it's like the what I see in these markets, not in general, it's the type of cities that you're just kind of like, hey, that sounds good at that price point, but like the bad experience could go really, really bad because maybe I'm in like one of these violent neighborhoods and have one of these like really bad things that happen in my home, or, like these kinds of things that if I want to go fix it myself, I don't even want to step foot there, kind of thing. That feels like the low end of the experience piece that I would completely want to miss.
Well, yes, you're right about that. Yeah. You got to ask yourself, why are these markets so low priced?
Yeah.
Why is Detroit priced at whatever, 75,000? It's more like 150,000.
Yeah.
But why is Detroit priced there? It's because people are leaving Detroit and moving elsewhere.
Yeah.
Population growth or population declines are very, very related to what is your home price and your price appreciation rates. And home prices have not been growing in Detroit compared to where they have been growing for the rest of the country.
Yeah.
And definitely not Jacksonville. Yeah. And when you don't populate in your area, that gets risk.
Yeah.
We just talked about how rental demand is. Population growth is a great indicator of rental demand. Well, if you don't have population growing and it hasn't grown. It's picking on Detroit, just happened to be here, but population is declining in Detroit. I can pick on Cleveland. I pick on Cleveland a lot
Yeah,
too,
but it's not on this list, GC.
It's not on this, but population is declining in Cleveland too.
Yeah.
Go Steelers.
Yeah.
If you're in a market where you have population that is not growing, at least at the national average, opening yourself up to risk somewhere else. And so you kind of get in, you like it, but think about the dynamics of why it is so low priced today.
Yeah.
It's because for so long has not had home price appreciation that has matched the rest of the country. And if you go one step beyond, it's because population hasn't grown there like it has in the rest of the country. Think that you want to be in a market where it has high population growth because that mitigates your risk, your renter leaving. That mitigates your risk of vacancy. That mitigates your risk of rent declines. And then of course, population growth leads to high home appreciation in the long haul.
You know what hit me as I'm looking through this list, GC, is I'm not trying to make a generalization of the people there or anything like that, right? But like I think of, how pumped up am I to get in a market? And I look at three of them, right? Like I look at St. Louis, Detroit, and Baltimore, and I immediately think of like headlines of violence. Right, like it's just these cities that have gone through these like rough periods in recent history, and know that it's happened. And then I look at it and I'm like, Kentucky and Alabama. I've been to Louisville, Kentucky. I think it's awesome.
Yeah,
I think it's a really cool city. I bet that if you ask the average American what they think of Kentucky or Alabama, they have a certain image in their mind, right? Like, so it's like these can be these smaller markets that have the opportunities in them. But I think marketing kind of matters to a certain extent if you are when you're thinking of like what you're getting into and how pumped up you are, and do you want to be like in these like cities that have made headlines for crime, or do you want to be in something else that hasn't happened? In Louisville and Birmingham, I just think of it as just like sleepy southern towns that like aren't really making much headlines about anything. Right. Like there just isn't like a lot of like momentum happening there that are making these like national lists outside of this like rookie market list.
I think it's just good to have a regular everyday perspective of the city, because you know what leads to population growth or population declines, because that's one leading indicator. It is, what is your perception of the city? And I think everybody had a little bit of a different perception, but it matters when you think the cities that you're more likely to move to. You weren't considering Louisville or Birmingham or any of those cities. You were considering Jacksonville. Yeah. Because
I've seen in a bunch of different headlines about fastest growing cities and like all these other things that have been happening, and like the best places to live and stuff like that. There you go. Which leads me to the next, the final kind of like the cities that were in like the Goldilocks zone is Jacksonville, Houston, and San Antonio. The first thing that I think of if we're coming at it from this like headline thing is Texas and Florida. Texas and Florida have had a bunch of immigration. They are kind of like the bells of the ball of the winners of this like Zoom economy where you can live anywhere. People are moving to these places that are warm, that have low property taxes, that like have all this kind of like opportunity mix. And I'm not surprised to see Houston and San Antonio in these ones, along with Jacksonville as well.
It's the truth, right? Yeah. It's a state where you have no state income taxes. There's high population growth. There was high population growth even before COVID. Yeah. And then after COVID, it has continued and accelerated. And they're still affordable. Yeah. I mean, there are other cities in Texas that you can't get positive cash flow in today that you could 5 years ago or 10 years ago. Houston and San Antonio represent opportunities that are still affordable and then all significant rental demand, just like Jacksonville.
And I would even go a step deeper, right? So like Houston, I think is already kind of like a little bit more excessive in this list already, right? But it's like the two that's the most, and I'm starting to like have this rubric of you want to be in a place with these like positive tailwinds, and maybe you don't want to be the first, second, or third city that comes up in your state when somebody mentions your state, right? Like you think of Texas, you think Dallas, Houston, and Austin probably, and then there's San Antonio, right? Like, I mean, and then you think of Florida, you think Orlando, Miami, Tampa, and then there's Jacksonville, right? And no surprise there that there's this like opportunity of like city that is still underpriced, high quality of life because it shares the same dynamics of all these things. and these like positive things that are happening in real estate, and you can get in, and people are moving there as well.
That's exactly right.
Yeah.
You know, you want to, and that's why you want to be in that market that is not the first city that you think of in that state, because everybody has thought about that for a time. Most of the time, at that point, the affordability is not going to be there. The positive cash flow from day one not going to be there. So that's where it fit in really nicely. And San Antonio is the same. It's a major city, so it just happens to be very affordable in Houston. But us in San Antonio, definitely similar. There are similarities.
Yeah. So then let's talk about why BiggerPockets picked Jacksonville #1. BiggerPockets ranks Jacksonville #1, citing affordability, Florida lifestyle, a bustling port, a large rental pool, an institutional validation, 21% of single homes by corporations, the median home price, and you get affordability relative to many coastal major markets. You get strong renter demand and population growth. You get diverse economy, port logistics, military, financial services, long-term appreciation potential, and the validation of like, you know, like institutional investors that have seen it and kind of provide a certain level of like consistency market.
I think that when I look at this entire list, the reason beyond the reason that I you know, obviously I invest all of my rental properties in Jacksonville, but beyond that, I look at this list and I think that there's an opportunity here to have the best of maybe not all worlds, but really, really good of most worlds here. It's kind of the way I look at Jacksonville to some of these other cities. And, you know, Jacksonville has that affordability that we are talking about. So it is cash flow positive from day one, especially with these incentives that we're talking about now. That population growth leads to high home price appreciation and rent price appreciation and occupancy from the rental side. Did you know that we have 98% occupancy right now?
It's pretty awesome.
Yeah, that's just JWB. The market is a little bit lower here in Jacksonville, but yeah, 98% occupancy. You do that in a market where there's strong rental demand and population growth. And then we've talked about the diverse economy. The interesting thing so I look at San Antonio and I just look at the list here.
Most comparable.
Yeah. I think there's a lot of good things to say about San Antonio. A lot of the same things that I just shared about Jacksonville, very similar to San Antonio, I would imagine. The cool thing about San Antonio versus Jacksonville is I just went to San Antonio and I had a blast because the Gators won the national championship in basketball and I went to the Final Four and I had a blast in their downtown.
It's a cool spot, man. I was just in San Antonio too.
So cool.
Yeah.
So if you get to Jacksonville, our best days are ahead of us for our downtown. Buddy on the show, if this isn't your first time hearing this, it won't last. We are big believers in downtown Jacksonville. We think it's a once in a generation type opportunity to hitch our wagons and property investors to the next American downtown. I believe that's Jacksonville. And we know that home prices double compared to the national average when your downtown becomes revitalized. So downtown San Antonio is awesome. But it is not in early stages.
It already happened.
It already happened, right? Jacksonville is. So we think that we have an advantage over San Antonio, really the rest of the country when it comes to that special sauce is the down revitalization. But yeah, comparing us to the mature markets, the ones that are overpriced, just a lot of money to get into those for a lower return on investment.
Yeah.
The lower price markets, a lot of risk in many different forms. If you get in based on a low price tag, you really be in these markets that are just kind of these hybrid in the middle. And, you know, you look to Texas and Florida and you find, you know, a few darlings right there, Jacksonville, San Antonio, and you know, maybe Houston, some pros and cons, but I like Jacksonville and San Antonio on this list.
What I'm most interesting about this list, GC, is that the two things that I feel like we talk about the most on the show these days is the order of operations of operator first, right? Like the list mentioned it, but it didn't say Jacksonville is #1 because it has the best vertically integrated turnkey property operator for investors, right?
Ask him to go back and edit the article. Put that one in there.
Well, just saying, right? Like I think if we're gonna hold true to our principles here,
right,
like this list is validating that without mentioning the fact that, like, you know, I don't know if there's another operator like JWB country, right? Like in any of these cities or whatever, but we all know that one of the reasons that, like, the main reason that we invest here is because of this like unique vertically integrated model JWB has built here in Jacksonville in the city, and because we all love the downtown story of, like, you know, being in with a with a market that's doing well, and we know that it's about to pop even more because of all these numbers and all these inside track and everything that we've had. And this list has come out of like the top 10 cities to invest in for a rookie investor. Very similar criteria to how we would rate it, right in line with our point of view, and puts Jacksonville number one. And it isn't even mentioning or taking into account the two things that we really, really believe in, which is the best operator in the country is here, perfect for passive investing, and this great American downtown is going to happen that nobody's about outside of the Natural Average show.
Oh,
so
well played.
I think that's cool, man.
Oh, you know what? I love it.
Yeah, good job, Bigger Deeper, bigger. It is BiggerPockets. I got it right the first time. I never do that. All right, one more question from Brian McKay. Do you put together a 3 to 5, 10-year average equity stability chart? I think it's way easier to stay plugged into your goal of letting the tenants make your future profits.
Yeah. That's BJ McKay. Yeah, BJ, your current client, just reach out to your client, your portfolio manager. We do that kind of planning for our clients, and happy to put that together for you.
Okay, cool. You see, good show today, man. I enjoyed breaking this thing down. Like, I like when these lists come out. Like, I like going through the criteria. I am like genuinely, like surprised that they agree with us putting Jacksonville number one, but they didn't even mention like the aces in the hole that we love talking about.
And I'm not surprised.
Yeah,
I'm not surprised because we win even without this other downtown story. We do win here in Jacksonville if you take that off the table. That's why this is the downtown story is the extra thing on top. But the more important thing than the downtown story or how all the numbers worked on all these comparisons, invest with the best team. That has to be the takeaway. More important than any list. You don't like it's worthy of managing your money. Don't invest with them. Put all of your time and research into finding the best team and then start to come down the path and finding the right fit.
Yeah. Number one key to rookie invest is survivability. Survivability is based on the experience. Experience comes from the team. Everything else helps, but the team is going to make or break it for you. All right, you see, next week it's a big show, right?
Oh yeah, we got the market outlook, Q3 market outlook. It's going to be a big one.
Any sneak peeks about what you're thinking about?
Oh man, I just read data for the Jacksonville market date for prices, for days on market, for home appreciation rates. I think it's going to surprise some folks. It's going to be very, very surprising. I can't wait to show it to you.
All right, we got some new data coming out on the market update. I want to thank the community for being here, being a part of this. It was lively. It's a little bit harder for me to read the chat in this new scenario. My eyes will adapt as they twinkle on, I promise. But thank you enough for being here. 60, 70, 80 people showing up here on a Tuesday, middle of the workday. Continue to get yourself educated on this stuff. You're what makes this show special and the community. This is really, really a community. So thank you for being here. Hope to see you on the market update. Bring your friends. We know that this is the most attended one. We know that it's the most interesting stuff that Greg puts the most effort into. He has some sneaky data to show you. And from here till then, any advice for everybody?
Don't be average. See ya.